Hello everyone, my name is Givmo Maguju. I am a financial analyst at FundMe Capital. Today I'm going to show you how to perform ratio analysis. So we are going to use Walgreen historical data that is from 2006 to 2010, right? So we have got the income statement here, and we've got the cash flow statement, and we've got the balance sheet, and then we have got the ratio analysis tab here, where we are going to compute or calculate the ratios. So I've put the metric column there, and I've also put the formulas that you need to know or to master in order for you to be able to calculate or to perform ratio analysis, right? So don't worry about the cash flow statement having 3 years of financial data. We are not going to use the cash flow statement. We are only going to use the income statement and the balance sheet to compute the ratios that we want. So as you can see here, we've got internal liquidity ratios. So we are going to first of all compute that. We are also going to compute operating efficiency ratios, and we are also going to compute operating profitability ratios, and lastly we're going to look at the Pont System or analysis. So let me just as a side note that in this tutorial I'm only going to focus on the practical aspect, right? Just to demonstrate or to show you how to calculate ratios. Then in the next tutorial I'm going to explain what these ratios that we will compute in this tutorial mean to you as a business owner, or as an investor, or as an investment analyst, right? So without wasting time, let's dive right into it. Right. So first of all, like I said before, that we want to compute internal liquidity ratios. So we've got the current ratio, we've got the quick ratio, cash ratio, the receivables turnover. Okay, so in summary, the cash ratio, we just want to see whether our current assets are able to cover our current liabilities. So let's just compute that ratio. So let's just so we will be computing for 3 years, that is from 2008 to 2010. In some cases it is recommended that you compute for a period of 5 years, so that you can see the trend. So here to compute current ratio, you have put a formula there. So the formula for computing the current ratio is current assets divided by current liabilities. So we'll be using the balance sheet to compute this ratio. So on your keyboard, press hold down Control and then press page up, right, to get to the balance sheet or to navigate to the balance sheet. Then here we have to find this row, that is row 10, and then we need total current assets figure, that is for 2008, and then we press the divider arrow there, and then we go down to the current liability section, and then we select the total current liabilities figure for 2008, and then press enter on your keyboard. All right, so now we can on your keyboard again hold down Shift and then press the right arrow up until you get to 2010, and then on your keyboard again press Ctrl R. Whilst 2008 and 2010 figures are still highlighted, or ratios are still highlighted, on your keyboard press Alt H0. We just wanted to add to make it 2 decimal places. So that's the reason why I pressed the Alt H plus 0. Right, so basically we have now computed our first ratio, which is the current ratio, and we can see the current ratio for 2008, 2009 and 2010. Right, then let's proceed to quick ratio. So now quick ratio is also known as the asset test ratio. In this ratio we remove inventory, right? So from the current assets we remove inventory, and sometimes we remove other items that we may not know, especially items that may be deemed as portion of long-term fixed assets, something like that. So for the purpose of this tutorial, we are going to make use of cash, short-term investment and receivables to compute the quick ratio. So let's just do that. So we are going to use the balance sheet for this ratio as well. So press equal sign to start the formula, and then on your keyboard hold down Control and press page up to get to the balance sheet. So before I do that, okay, let me just proceed and then I will show you what I wanted to say. So here we get to 2008, and then we say plus, we add the short-term investments, we add the receivables, and then we look for the total liabilities figure for 2008, and then we press there. Right, so you see the problem that we had there. It is given us a weird figure and it doesn't make sense at all, which means we have made an error in our formula. So let's just delete that and try again. So let's press equal sign to start the formula, and let's just open brackets there, and then hold down Control and press page up, and then let's go to 2008, add cash, and then add short-term investments, add accounts receivable, and then close brackets and look for the total liabilities figure for 2008. Just like that. That's making sense. This is much better. Then let's make it 2 decimal places. So on your keyboard hold down Alt, so press Alt H and then 0. Perfect. Now let's proceed. So now what we have been comparing is will our cash plus short-term investments and receivables be able to cover our current liabilities. So you see these ratios now, we compute them based on the level of liquidity of the assets that are involved. For example, the quick ratio says cash is highly liquid, right? And short-term investments, let's say maybe this could be money market investment, those as well are highly liquid. And then we've got the receivables. These our customers can pay anytime, or we can speed up collection. So which means we will have enough cash to cover our current liabilities. As compared to inventory, inventory can take long to sell. So for example, if it depends on the type of a company, right? If you are selling fast-moving items, then I think the current ratio makes sense. But as for the quick ratio, we will just looking at highly liquid short-term investments or current assets, right? So let's go to cash ratio. Now we are saying, let's see if our cash and short-term investments are enough to cover our current liabilities, right? So we just want to see how liquid our business is, okay? And here we on the current asset side, we are only going to make use of our cash plus short-term investments divided by current liabilities to compute the cash ratio. So let's just do that. We are going to use the balance sheet for that. So press equal sign to initiate the formula, and then hold down Control and press page up, and you see we are repeating the same problem again. So let's just go back, go down, control and page down. So here what we need to do is we need to open bracket because there's some adding that we need to do. So page up, and then we add cash for 2008, and then short-term investments, then we divide it by the total liabilities figure for 2008, and then we copy to the right, and then we add another decimal place, old age 0, just like that. So perfect. Now let's go over to receivables turnover. So we just wanna see how many times do, let's say, our company collect money from debtors or from customers per year. Okay, so this is what we are trying to see here. Okay. Right, so that's perfect. So to do this, receivables turnover, the formula here is receivables turnover is equals to total sales divided by average receivables. So that's what we are going to do. So we will use the income statement and the balance sheet to compute this ratio. So hold down control and page up until we get to income statement, and then we choose sales for 2008, and we divide by average receivables, then go down control and go to the balance sheet. Here we look at the accounts receivable. So we're going to use, since it's an average figure, we need to compute 2007, and we need to use figure for 2007 and 2008. Like this, and then we close and right. Perfect. We copy to the right, and then we add a decimal place just like that, and we need to calculate average receivables collection period. So to compute receivable days, there are two formulas, okay, and I will show you which formula I favor the most and which formula that is mostly used by analysts when they are doing financial modeling and all that. Right, so this is the traditional way of computing receivable days. Okay, so to compute receivable days using the traditional way or the first method, you divide the period, which is 365 days, by the receivable turnover ratio. Okay, so let's just do that. So we do this, we divide this by this, and then we get the average receivable collection period or days. So in other words, the company it collects money from debtors in about 14 days, or it takes 2 weeks to collect money from our customers. It's those customers who buy on credit. Right, so let's just see the other method. This is the most commonly used method that is used by financial analysts, that is used by even investors. So this formula now, we start with average receivables. So let's go to average receivables. Right, so average receivables, then we divide by revenue for 2008, and then we multiply by 365 days, which is the period, and look at that, it gives us the same result. So yeah, that's perfect. So so this is the average receivables collection period. The firm takes approximately about 2 weeks to collect money from customers. Right, let's calculate the inventory turnover. And before we calculate that, one thing to note is when you are calculating the receivables turnover or the receivable days, receivables, we use revenue from the income statement. So receivables are related to revenue in the income statement, and inventory is related to cost of sales, payables cost of sales as well. So let's just calculate the inventory turnover. How many times does our inventory turn? Like how many times do we order our inventory per year? So let's just calculate that. So this, we say COGS, or cost of goods sold, divided by average inventory. That's the inventory turnover there. So let's go here. We look for cost of sales. We divide it by we divide it by average inventory. Right. So now we just need to make that to decimal place, and then let's calculate the average inventory period divided by turnover there, which is perfect. And then let's use the method that we love. This is, so we say average inventory. So average inventory, then we divide by cost of goods sold for 2008. We multiply by 365, and then we get the same value. Then let's go over to payables. So here we just want to see how many times do we pay our suppliers, right? And also to compute how many days do we take to pay our suppliers. So we start with this. We use cost of goods sold for 2008 divided by average payables. So we look at trade accounts payable, right? Just like that, and that's it. And then we calculate the days that we take, and just like that. So in other words, we approximately we take a month to pay our suppliers. So that's good, because we collecting money from our customers very fast. At the same time, we are delaying to pay our suppliers, which is a good cash flow management technique. Yeah, so that's perfect. And here we've seen that we are even speeding up collection funds from customers, and here, yeah, which is a good thing, right? So let's use our method there. Okay, so right, so we're going to use average there. So average, right, and then we divide that by cost of sales, and then we multiply by 365, and then we get the same result. All right, so now we look at the cash conversion cycle. We just want to see like how many days does cash, how many days is cash committed to receivables, inventory, or payables, right? So the basic idea here is to see like how many days does a business operate without having to collect cash from its customers, and how many days does cash remain committed in inventory, things like that. So to calculate the conversion cycle here, we add receivables plus inventory days, and then we less the payables payment period. Then we get the cash conversion cycle. So basically, when we are looking at the cash conversion cycle, we're looking at working capital, right? Working capital management and all that. And cash conversion cycle, mind you that when we purchase, let's say, inventory for resale, then it's not like we buy inventory today and then we immediately sell it, right? So there's a time that sometimes there's a time that we may spend without receiving the inventory, right? And there's also time that the inventory will stay in our warehouses without having been sold. And at the same time, if our customers buy from us on credit, there is a time that, for example, the firm is taking 14 days to collect money from customers. So which means that 14-day period, is the time that we are operating without receiving that cash, rather than if we would have sold the products on cash. So that's the basic idea, in fact. So let's just link the receivables collection days. So let's just link this, and inventory processing days. Let's just link that, and let's link payables payment period. And then what we're doing here, we are adding this and then subtracting this, right? Perfect. So basically, in 2000 we took like 40.6 days. That's the cash conversion cycle there. Now let's look at operating efficiency ratios, right? So total asset turnover, we calculate it as total sales divided by average total assets. So we will use the income statement and the balance sheet. So total asset turnover there, we go to the income statement, we grab the sales figure for 2008, we divide it by average total assets. So we go to the balance sheet, we look at the figure for total assets like this, and then we close brackets, and boom, that's it. So perfect. So let's just add another decimal place there, 100, and then we need to compute the net fixed asset turnover ratio, right? So the net fixed asset turnover ratio, in other words, we just want to see what's the contribution of our assets to revenue generation. Basically, that's what's happening there. For example, a low asset turnover ratio, we'll discuss that. What does it mean? Okay, a high efficiency ratio, what does it mean, right? For example, if the company is operating using dilapidated or obsolete equipment, right, that can also be explained by an efficiency ratio. So we're gonna cover that in the next tutorial, so stay tuned. Now we have got net fixed asset turnover ratio there. This when we calculate this, we are only focused on fixed assets, right? So we will not include current assets there. So by saying fixed assets, it means both tangible and non-tangible fixed assets, right? So that's what we are going to do, but we also use sales. So we go to then we go to the income statement, then we grab that, and then we say average total fixed assets. So we go back to the balance sheet, then we have got the figure there for the right, and then we close just like that. So that we added a small place there, right? Then we have got tangible fixed asset turnover. So here we compute the physical assets only, right? So we are only taking and then we say average. So this one is gonna be a little bit confusing because if we go to the balance sheet, you will see that there's a balance sheet line item that's saying other non-current assets. So we're not sure what these are, but we have to include them. But this time around, we are excluding tangible items such as goodwill, right? So what we need to do here is we need to average this. So we have to sum this and sum this, then we close, and then we open another sum, and then we come here, we sum that, and we add that as well, and then perfect. So we just copy that to the right, and then that's fine. Then we compute equity turnover, which is total sales divided by average total equity. So we go back to the income statement, we grab our 2008 sales figure, we then go back to the balance sheet. Down there we look at the equity section, then we take the average figure there, average figure, then perfect. So now we just add a decimal place, and that's perfect. So we're going to discuss in the next section what these ratios mean. And then let's look at the operating profitability ratios. We've got the gross profit ratio, the margin, gross profit margin. So this one is simple to compute because it's just gross profit divided by sales. So let's just go to and look at the gross profit figure for 2008 divided by that, and then we copy that to the right. And operating margin, then we look at the operating income, we divide that. Okay, so in case you may be wondering why each time that I'm computing these ratios, they are being shown automatically in percentages. Okay, if on your side is different, all you need to do is highlight this row, and then on your keyboard press Alt HP, okay, and then press Alt H0 to add a decimal place. Then let's compute the net profit. So we use net earnings for 2008. We divide that 100, and then return on total equity. So return on total equity, it's computed as net income divided by average common equity, right? So there's a kind of difference between return on total equity and return on honest equity, right? So return on honest equity, now we're saying let's say on our capital structure there could be preference shares, so we need to factor in, or we need to remove preference dividend from net income to correctly reflect the return on honest equity, right? So now that's what we need to do. So let's just initiate the formula there, and then let's go to the income statement. Let's select net earnings. Then let's use average common equity, and let's just do that and choose this as well. Right, so perfect. Let's copy that to the right, and if we come here, you see that we don't have any preference shares. Look at the shareholders equity there, we don't have any preference shares. So let's just go back here, so which means the formula will be just the same. So let's go here and let's use that in average equity, right, and then let's close that and let's copy that to the right. Then here it's a matter of just linking so we are linking. All right, that's fine. So now we're looking at the DuPont system or analysis. So DuPont analysis, it's a way of breaking down return on equity, right? So what we are doing here is because return on equity is just net income divided by average common equity, right? So we break down that ratio to say it is affected by net profit margin. It is also affected by total assets turnover. It is also affected by the financial leverage. In other words, return on equity is affected by the operating performance of the business, the efficiency, and how indebted the firm may be, right? So now we just say net profit. We have computed that already. So net profit margin, and then we copy it to the right, and then total assets turnover, we just copy that here and then right, and we have got return on total assets, which is a product of net profit margin times total assets turnover, right? And here we have got financial leverage. So financial leverage, it's total assets divided by average equity, right? So that's what now we want to do. So let's just do that. Total assets. So let's just say total assets divided by average. Total assets divided by average equity. Okay, let me go back to the balance sheet. Average equity. Perfect. So we just copy that to the right, and then we add a decimal place there, and here we just multiply that, and this one and this one. Okay, and then let's just perfect, just like that. So basically there's a slight difference, right, between this row that we have computed using the DuPont system and this row here. So thank you guys for watching. We are going to explore and explain the DuPont system or analysis further in the next tutorial to come. So thank you so much. If you haven't subscribed to our YouTube channel yet, please take this moment to subscribe. We really thank you for that in advance. So please share this video if you have liked it with your peers and friends, and make sure you put like and comment, with all your suggestions, what you think about this tutorial, what areas do you need me to cover. So thank you so much. We appreciate your time. Thank you.